speaker is from ATS Trading Solutions from Brisbane. As mentioned before, I don't know if anyone remembers the name, it was just mentioned. He's a regular on Top Traders Unplugged, a podcast, which if you listen to podcasts, definitely give it a listen. He's going to talk to us about why a trend following and rule-based systematic approach to trading can offer increased diversification and give you an edge in the current markets that we have. And I think this presentation will really open up your eyes to for a new way on how you can profit in the financial markets of how they're going at the moment. So give it up for Richard Brennan.
Typical disclaimer, everything I say shouldn't be used against me. Here we go. So what we're going to be talking about is the trading opportunities that uncertainty brings. Now, 2022 has been a very challenging year for investors. Uncertainty is a very good name to describe 2022. We've had geopolitical uncertainty with the Russia-Ukraine war. We've had the China slowdown. We've had massive increases in inflation. We've had central banks which are sort of slow to move, lifting interest rates behind it. There's all of these different factors which together conspire to create this very uncertain market regime we're experiencing at the moment. Now, in this zero-sum game we call trading, people that are struggling at the moment will be saying to themselves, what can I invest in? What can I do to help myself out in this situation where I'm finding that my equity is declining, it's very uncertain, I'm not sure what's happening in the future. But in this zero-sum game, there is a particular group of traders and investors that specialise in a particular process that actually do exceptionally well during periods of uncertainty. And this is the trading group that I refer to as diversified systematic trend followers. Diversified because they are diversified across many numerous different asset classes, such as equities, commodities, metals, gold, fixed income. They're also diversified in their time frames that they trade these trend following models, and they're also very diversified in the extensive diversification with their different trend following systems deployed. So massively diversified. They're systematic because they adopt rules-based approaches which are typically driven by algorithms after rigorous, robust testing through comprehensive backtesting processes. And of course, they're all specialised in trend following. Now, trend following, really every single investor and trader, apart from those people that might sell options, are really trend followers. They're all looking for a directional move in price from a low to a high or a high to a low, long or short. So whilst everybody really is a trend follower to varying degrees, what sets the diversified systematic trend followers apart from other types of trend follower or other types of trader and investor is specifically targeting what we refer to as outliers or anomalies, things that are massive in directional extent. So before we start, I just thought the first thing to do is provide a context of what we're referring to when we're talking about uncertainty. So here is a 22-year chart of the S&P 500 Total Return Index, including dividends. We see this is the actual equity curve of the S&P 500 Total Return from 2000 up to September currently, or last month. We noticed that in the period from 2000 to 2002, the equity curve declined and we had a significant drawdown in the S&P 500. So an investor who was adopting a buy and hold approach with the S&P 500 would have faced a drawdown at this point of around about 45% in 2002. This was a period of uncertainty for those people in equity markets. We had the GFC in 2008 through to 2009. This also gave another 50% drawdown in the S&P 500 Total Return Index. And we've also had three more recent periods of systemic shock in the equity markets, prompted by the trade wars, Donald Trump's trade wars back in 2018-19. Of course, the COVID impact in 2020. And we have now, currently, an environment of inflation and the Ukraine war, which is creating a significant downturn in equity markets and a commensurate increase in the equity curve. Now, the thing about this is that a buy and hold investor, if they are holding for the last 22 years, there would have been 2 periods here where they would have had drawdowns of almost 50%. So in other words, if they'd invested $1 million in the market, they'd find that at some point in time they would be holding 500,000 or half of their equity. Now, it takes a particular very strong mind to be able to hold their equity when there's such a significant slump. So whilst it's sort of very easy to say, well, I could just be easy and do a buy and hold in the S&P 500 index, you'll notice that these drawdowns can be significant and will really test the psychology of the trader. So that paints a picture of what I'm referring to as these uncertain regimes. We've got 5 of them in a 22-year history. Now, what we've got here is we've got 5 different equity curves. So the red is the S&P 500, what you've all just seen now. The purple line here is 100% allocation in bonds, US bonds. You'll notice that it's had a fairly graded, very linear sort of extended slope of growth, but now we're facing a downturn in bonds. So when we combine an allocation of a portfolio, so let's say we allocate a 60-40 portfolio, 60% towards equities, 40% towards bonds, when we combine those 2 curves together, we get that light brown curve here, which is a traditional 60-40 portfolio, which is a very popular portfolio, especially in pension plans, superannuation. It's a typical go-to portfolio which has provided a degree of protection during adversity. So what we find is when the S&P 500 was doing a big decline in the tech bubble collapse, we noticed that there was a slight rise in the bond profile. So that was providing a degree of protective cushioning so that the impact on the 60-40 portfolio was not as severe as the S&P portfolio as a 100% allocation. We also find this protective cushioning occurred here in the GFC. Bonds continued with their subdued linear growth while equities were tanking over this period. We find that this situation was consistent. We got a degree of protective cushioning from bonds right up until 2022. And in 2022, we had a regime turn from quantitative easing to quantitative tightening, rising inflation. What happens with rising inflation and rising interest rates? Bonds go down in price. There's this inverse relationship between interest rates and bond prices. But there is no longer this protective cushioning provided by bonds because, as you'll notice, the bonds are deteriorating, the equities are deteriorating. So when we combine a portfolio, a 60-40 portfolio, that's also going to deteriorate, which you see here. Now, another thing to notice is that the bonds, whilst they have provided a degree of protective cushioning, they're not really adding or lifting the equity curve of the total combined solution. So that light brown colour is the total combined 60-40 portfolio. So it was getting a degree of protective cushioning, which is what we refer to as improving its risk-adjusted returns, lower volatility, but it wasn't significantly increasing the curve up. Now, what we have here is an index constructed, the Top Traders Unplugged Trend Following Index, comprising 60 trend following programs, which are just rebalanced monthly based on trading programs or trend following, diversified systematic trend following programs that have at least a 15-year track record. That's important for the TTU-TF index because it's a very robust index looking at the long-term performance of the very robust candidates. And we find that not only does it provide these magnificent correlation benefits during downturns, so we see in 2002 S&P 500 going down, but a big rise in the TTU-TF index. We had a big decline here in the GFC of S&P, a massive increase in the TTU-TF index. In all of these instances here, except one, which was a very sharp short corrective downturn back in the trade wars back here, we find that there isn't an uplift in the trend following index, but in all other examples, and currently today, we see a massive growth in our trend following index at the expense of the declining S&P and the bonds. So trend following has these qualities which would be great for people to consider. Well, rather than a 60-40% portfolio in equities and bonds, how about a 60-40 portfolio with 60% equities and 40% trend following programs? Because we get all of the protective cushioning benefits, plus we get this massive lift in our equity curve. So when you look at a 60-40 of the trend following programs, that's the blue line here, you'll see that it's massively lifting up the overall return of the portfolio. And that's because trend following programs are harvesting alpha from these opportunities of booms and busts. This is a story of fear and greed. It's not just that trend following programs offer significant uplift during times of adversity, they also offer significant uplift during times of boom. Because there's a behavioural psychology that starts influencing traders through the fear of missing out, through adversity, which changes the way they trade, the way that their trading models, their behaviour, they abandon their prior behaviour and they start becoming trend followers. So this is just to show that it's not all about adversity, because we also get significant uplifts in the equity curve. Well, this is actually the adversity pile. So we had 4 instances of stock market adversity where trend following came to the rescue. But this one instance here of a short, sharp corrective move with the trade wars and also Volmageddon, what happened during those short, sharp corrective moves, we find that trend following programs don't have sufficient time to adjust to those moves. So trend following programs work well when the moves are extended. So when we start getting significant downturns, we find that trend following programs come to the rescue, because what markets are doing during those particular phases is they're trending, and trending is a sign of uncertainty. So how do trend following programs compare to some other programs you might be familiar with, such as Berkshire Hathaway's or Warren Buffett's Berkshire Hathaway? Well, Berkshire Hathaway over the last 22 years is the yellow line. You can see that Berkshire Hathaway is facing a similar problem to the S&P 500 in the current regime. It's declining in value. But you'll notice that these are 10 different trend-following programs, the programs that we're talking about tonight, have outperformed over the long term and are now getting massive acceleration. This here is the returns of a program called Mulvaney. Paul Mulvaney operates a diversified systematic trend-following program, and his year-to-date returns is about 137% from January through to October. So he's had massive performance, and that's because he's targeting this edge that lies in market uncertainty, which we're going to be discussing a bit further. But it's also during periods of boom we find that we have significant uplift in the equity curve of trend following. This is when the share market's increasing. Notice trend following index also increasing. Over this period here, share market increasing, trend following index also increasing, albeit at a greater rate. These periods here, trend following significantly increasing. This period here, significant increases in the S&P 500, but also significant increases in the trend following programs. This is when the fear of missing out's coming in. So this isn't the tale of adversity, this is the tale of booms and then ultimately busts. So a lot of people say, well, trend following programs are very uncorrelated with the S&P 500 or bonds or the 60-40 portfolio. We see that in the overall statistic up here over the 22 years. We see that it is almost completely uncorrelated to the S&P 500 with a minus 0.1 degree of correlation here. to the 60-40 portfolio, minus 0.08. So clearly it's uncorrelated with equities and with bonds. So there's a different behaviour going on. But that statistic is to be expected because diversified systematic trend following diversifies extensively across a vast array of different asset classes. So it's always going to be uncorrelated to a single asset class, such as stocks or equities, or to bonds, or to even commodities in isolation, or to it's going to have this low level of correlation because of its extensive diversification. But do not assume that because it is uncorrelated, there is no causal implications in the underlying assets. So I've already showed you that 4 out of 5 times during periods of stock market adversity, trend following has been negatively correlated during those regimes. Also, during periods of prosperity in the share market, we see that trend following has been positively correlated during those regimes. This combination of negative correlation during adversity, positive correlation during booms, summates to a low correlation over the length of term, but it's because it's targeting tails at both the upside and the downside in the distribution of returns because of this concept of fear and greed. When things get to extreme levels, we start seeing this different form of trading behaviour come into play that drives these trends further. So why does trend following shine during adversity? Well, the first thing is because of the simple system designs deployed. So unlike a buy and hold, there is no explicit design statement in a buy and hold. You just invest in the asset class and hold it, and over the course of time, hopefully it works out. But there is explicit design embedded in trend following models where they cut losses short and let profits run through the use of stops, trailing stops, and they let profits run by not using any profit target. So you might say, well, that's a bit silly. Why? There's no harm in taking a profit. But what we're saying is during these periods of uncertainty where outliers emerge from the financial markets, we always underestimate their significance in magnitude and extent. Always, because we always assume in a normal Gaussian way that statistically they're aberrations or anomalies. They should be excluded from the mindset. But they are the particular features of the market that the trend follower wants to harvest, wants to attack. These magnificent, huge trends, which often last many years. I know some of you might be trading the yen pairs at the moment. A great opportunity is in the USD yen pairs. I've been trading them since about 2020 in the long direction because they've offered these magnificent exponential growth and serious trending opportunities of the yen pairs. But most people trading them will be saying, oh, must take profit, must take profit. But we don't use any profit targets in our world of uncertainty because we assume that the human brain can never estimate the extent of these things. These things are nonlinear anomalies, and they are inevitably much greater than we ever anticipate or predict. So we don't use profit targets. We do use trailing stops. So with that in mind, those systems therefore ensure that if we get these magnificent extended trends for many, many years, we find that we capture them, or a large component of them, without any predictive logic. It's the design which is capturing the edge from these outliers. It's not any form of predictive assessment of the markets. So we deploy these simple design trend-following systems like a spider putting webs up in the market in a diversified way across every single different market we can get our hands on. These webs or these traps are set for when opportunities emerge which we don't predict in advance, and we take advantage of them. So the inevitable simple design produces what we call a positively skewed trade distribution. I'm running out of time. So what this means is that we cut losses short all the time. So we never allow our systems to go to the left tail, the adverse tail of our trade distribution of returns, But we find that there are significant profitable outliers which represent about 5 to 10% of our trades, which make all of our money. All of this rest, the 90% of trades here, just keeps us afloat. But this is what makes us the supreme edge of those diagrams before. So when we trade this in a very diversified way, here is a portfolio of different return streams of different markets. There's about 30 or so markets here. We see that at certain times we get these massive outliers, massive outliers, massive outliers, massive outliers, massive outliers. We find that these outliers are well distributed across the entire portfolio distribution. And what that does when you compile all of those different return streams together is it produces a great portfolio equity curve that appears smooth, but it isn't in reality. We're targeting these outliers. Diversification allows us to progressively improve the returns of our models through more aggressive diversification, and it also ensures that our volatility is managed at all times. So what this means is this is showing that as we progressively increase the diversification of our portfolios, we go from a wide dispersion to a very concentrated dispersion when we have a very highly diversified portfolio, increased compound annual growth rate, maintained volatility. This is how we catch our outliers. We're diversified with our trend-following system. So a lot of people would be familiar with the concept of pyramiding. What we do here is 8 different trend-following systems. It's not pyramiding as such because they're all uniquely configured, but they all let profits run and they all cut losses short. But you can see that when these outliers occur, they are non-linear in nature. They're massive moves compared to the normal everyday move. So these normal everyday moves are almost linear increases, linear decreases, but these are massive non-linear increases in price. And we magnify that non-linearity by having 8 models attacking it at the same time. So the reason all this occurs, I've got to wrap up really quickly. The reason this occurs is that markets are not normally distributed. We find that there's a zone of an edge which most traders attack, which is around the peak of the distribution of returns. This is what convergent traders, mean reverting, value investors, high-frequency trading, pattern recognition, they all attack the area around the mean, the area of predictability. In this area, it's an information-rich area. We've got a well-known mean, we've got a well-known standard deviation away from that mean. We use predictive models to extract an edge there. This isn't the area that trend followers focus on. We're focusing here on the tails. This is an information-poor environment, a Cauchy distribution, a pathological distribution. It's not a stable distribution. It's very unstable. We need these design-based models to manage risk. Otherwise, we find we capture those awful left tails. We want to avoid the left tails and catch the right tail. How frequent do these outliers occur? Well, according to Gaussian theory, or a normal distribution, there is a 1 in a 3.5 million chance of a 5 sigma event happening. But even in the S&P, over a 60-year historical record, we've found that there were 43 events of plus or minus 5 standard deviations in daily returns. It's saying that the frequency of these anomalies and outliers are much, much more than what we assume under a normal distribution and under normal statistical treatment. That's why we're targeting them. That's where our edge is. I won't go into this. I wanted to go into this, but I can't go into this. I don't have enough time. Effectively, what we're saying is that what causes price to move is trader behaviour. Trader behaviour implements the buy-sell decision. The buy-sell decision is actually what moves price. When you get collective groups of people doing similar strategies, they exert a similar force in the market through their buy-sell sequence. Their models are similar, their impact is similar. And so you could imagine the market as comprising ecosystems of lots of different participants with all different types of trading model, extracting an edge during normal market regimes. When markets are predictable, all of these different behaviours are being exerted, and we get this move towards equilibrium because of the counteracting pressures that occur in the market from all of these competing groups of collective agents in this complex system. They're all doing different things. However, when prices move substantially, what we find is that the predictive traders with these models that assume normal distributions, they assume standard deviations, they assume a standard mean, all of these trend following, trading models and investment models that assume normality find that they no longer work. Their models break down. Now, what this causes is an exodus from that model, and then what have they got to rely on? They don't have their models anymore. They've got to go to their behavioural tendency, fear and greed, fear and greed. When that occurs, they're either selling out of their positions, which is therefore the impact of that in trader impact is actually accentuating the trends. It's making them go even further. It's creating non-linear, amplified, magnified effects. So in these trading regimes, we're getting this change in behaviour, shifting from a convergent behaviour to a divergent behaviour, a convergent behaviour towards equilibrium, a divergent behaviour away from equilibrium. When we start getting away from equilibrium, we start going into the land of chaos. And in chaos, information poor, things can be extreme, we don't know how to predict it. That's what our trend following models focus on. So I'm going to wrap it up there, but that is a reason for why trend following had a magnificent performance over 2022. So if uncertainty prevails for the next 10 years, 15 years, we assume it is possible that this performance might continue. So that's why I'm so excited about sharing it with you, and I hope you enjoyed the presentation. Thank you very much.